right? Because day one and day two, those are easy. We go 1 cent, 2 cent, 4 cent, 5 cent, 8 cents, whatever. But then it starts to get really big. And I don't think people realize that. Like, also my takeaway too is like, you only really start to get into some really, really big sums of money, call it maybe day 25 and beyond, but really days 28, 29, and 30 is where it starts to, you get to see some of that compounding effect. And there's that famous quote from Albert Einstein where he says, compound interest is the eighth wonder of the world, right? Those who understand it earn it, and those who don't pay it. So my takeaways from this is like, days 28, 29, 30 is when you start to make some really big money, but then also how do we get to days 28, 29, 30? And, we're talking about real estate here mostly, but I think just generally speaking, the earlier you invest, the more prudent and the more you can see some of those compounding results come through. And then also I quickly, just two really quick slides. So Alan asked a couple of good questions last time about rent growth versus inflation. So I just wanted to follow up with that for the class. So here are two charts that I pulled. They're only updated through 2016 and the next one's through 2018. Generally, the answer is rent has tracked with inflation, although it's actually been a hair below. This is national averages. I thought that's kind of interesting from 1960 to 2016, kind of in line, but a hair below. It started to catch up at the end. What's been interesting to me is since 2000 till 2018, rents have outpaced inflation. So of course, the future, no one knows what the future holds, but I think relatively safe to assume that, rents will stay in line with inflation. And I think rental properties are a general good hedge against inflation, which is kind of all the rage nowadays that we hear in the news. So today we're going to be we're in class 2, how to pick a market, building your team. Just as a quick recap for those of you who are new to or just joined the class, the structure of this class is 40 to 45 minutes of Q&A, and then 40 to 45 minutes of content, and then we do about 15 minutes of Q&A at the end. The goal is to just wrap up by about 6:30 every week. And it's a 4-part class series. So class 1 was last week. We talked about why real estate, why invest in real estate. Today, we're going to be talking about how to pick a market, building your team. And then week 3, next week, is going to be analyzing a deal and negotiations. And then week 4 is kind of this woo-woo class where we talk a little bit about mindset and other real estate asset classes. So a quick recap for last week. Why real estate? And then this question of what's your why? We didn't talk about the what's your why all that much last week, but it's an important one. So maybe we could talk about it here for a little bit. I think I mentioned to you that if you're thinking about starting this real estate journey, it really is a journey. It's a really one step in front of the other type of process. It's not like you just overnight become rich doing real estate. And knowing what that why is, like for me, my why is to build enough passive income to travel with me and my wife, focus on other passions and maybe build other businesses, and then really teach others about real estate and building wealth. Like I've had a ton of fun sharing this message with friends and folks that I've met on the internet. Some of you that like on this class that I haven't met before in person, but really, really excited to have you here. But the why is important, right? Because if you don't know why you're going through this long journey, there's going to be stuff that's going to come up. Last class, I talked about a contractor scamming me, or hey, problems that you're going to face along the way. And even silly things, like the Lakers. I'm a big Lakers basketball fan. Lakers game is on. Do I watch that or do I look for another real estate deal? That question becomes a lot easier to answer every time when I know my why, right? And what I'm trying to get to. And then the other piece too that we talked about is just understanding the math and why that gives me comfort in real estate investing. And I put de-risking in quotations because you can't ever really fully de-risk anything, but I think there are ways like when you're owning a real estate rental property, part of that is cash flow. So that's protection. And then there's also another layer of protection where part of that payment every month is going towards building your equity, paying off your mortgage. And so overall, I think it's relatively, there's ways to kind of de-risk some of your risk in real estate. And then 2 things quickly, just to clarify, I got some follow-up questions about this. LLC formation and liability protection. Just wanted to clarify, like if you want to form an LLC, go for it. But my point on that was just there's so many questions around LLC and whether I should do this or not, that I don't think it's worthwhile, right? To focus on that, right? It just causes so much friction at that part of the process. So don't let that hold up any potential action. And do know that there are benefits. You get better loan terms typically if you're buying in your personal name. And then I think I was a little bit cavalier potentially last week about the risk, right? So I just wanted to share with everyone kind of the importance of having reserves, right? Typically 6 to 12 months of PITI, in other words, your mortgage payments plus insurance and taxes, is pretty adequate, right? If you can imagine, hey, if your tenant isn't there for 6 to 12 months, having that as backup for each of your properties is pretty substantial. And I think that's a good way to kind of de-risk as well. Okay, so let's talk a little bit about capital and like how much money folks have. I realize that on this call, there's just a wide range of folks of like where, backgrounds and where people are coming from. So I tried to put together a slide that kind of encapsulates how I would guide folks in different scenarios. So 3 different tiers. The first tier is kind of having almost no money up to 25,000. And just to be blunt, like I live here in California and Oakland, real estate prices are pretty high. Having 25,000, kudos to saving up that much, but it really isn't that much to get started in real estate, especially in California. So my general guidance to folks kind of in that tier is to really consider something called house hacking. It's really what it means is just owning your property and having roommates, renting by room. Because if you can rent out by room, especially in California where real estate prices are high, but then also rents are high too. So you kind of benefit from the high rents. You can really get rid of your most expensive expense every month, which is your rent or your mortgage. And then also this combined with what's called an FHA loan, or if you also served in the military, you qualify for the VA loan. So the FHA loan is a program that allows people to buy a home, primary residence, with only 3.5% to 5% down. It's amazing. And in many cases, right, depending on where you live, like in California, Northern California, it's considered a high cost of living area. So that loan amount can be up to $970,000. So you could buy $1 million place with only having about $30,000 down. It's an incredible loan program that the government offers. And then also if you're a VA, qualify for a VA loan, that's a $0 loan program that they offer. And then focusing on savings, either increasing income. You hear about side hustles a lot, but I think that's going to be important, and also drastically reducing your expenses. And then this last piece about wholesaling. Wholesaling is a way to get started in real estate with literally 0 down. In other words, you find a good deal and you sell it to an investor. And just say you find a deal that's worth $1 million, you find it for 900,000. You could probably sell that to an investor for 950,000. So you effectively pocket the spread there. And then this class, we're going to be talking mostly about tier 2 and tier 3 here. And these are all just kind of very general guidelines, right? It's not like if you have 500 and 1,000, you're in tiers. It's just general guidelines. But I think if you're in tier 2 here, I think you have enough kind of ammo to start to think about owning property directly, especially out of state, right? If a rental property in Philly is 200,000, right? Then you need about 25% down or $50,000 down for the down payment. And then also kind of thinking about other avenues to get started in real estate as well. You can partner, you can start to co-invest with friends. That's kind of how I got started buying, a 20 unit in Charlotte, most recently a 20 unit in Madison, Wisconsin. Those are with business partners and friends. We talked about the BRRRR method, the buy, rehab, rent, refinance, and repeat. And again, just to highlight, like if that term that I just said, BRRRR, is foreign to you, write that down and do some Googling and researching after this. It's really a phenomenal way to build wealth, period. It's kind of a real estate strategy, but I think when you understand how that math works on a BRRRR, it's really, really enlightening, and how a lot of people have made, honestly, just a lot of money in real estate. And then this last piece is about LP investing. So thinking about potentially buying a REIT stock to get exposure into real estate, or investing in someone's syndication. There's multiple different multifamily for apartments, there's self-storage, all these different avenues that you can pursue so that you have exposure to real estate. And then the last tier is if you have, call it 500,000 plus. And I realize that some people here work in tech or, founded a company and they might have quite a bit of capital to allocate. I think once you get into this tier, I kind of wanted to flag that you should probably be targeting bigger deals, right? It doesn't really make sense for you to buy that duplex in Cincinnati if you have this type of capital to deploy. And also there's this concept of if you're able to deploy this amount of capital, you can partner with an operator who will effectively do all the work and you bring the capital, right? And almost split the proceeds 50-50. There are folks kind of out there that, usually for an operator that's good, their bottleneck ultimately at some point becomes capital. And then just to highlight again, like just getting exposure to real estate, I think is prudent for folks generally to have a balanced portfolio, and investing in a REIT or LPs, that could also be a very worthwhile thing because it's zero effort on your end. And one thing too to highlight, like if you have that much capital, 500,000 or more, it really likely indicates that you have a strength outside of real estate, especially if you're in this class right now to learn about the basics of real estate. And that I think I'd also don't want you to push to the wayside, which is, there is benefit to potentially staying in your lane, focusing on what you're really, really good at, and then just getting diversification in real estate. Not everyone needs to own 50, 100 rental properties. And then the last point, I think if you're in tier 2 or tier 3 here, I do just want to highlight, I get this question asked a lot because I'm a realtor. I run a real estate team here in the Bay Area, and always the question becomes, hey, I have X amount of money. Should I buy a home first, or should I invest in real estate with that money? I'm biased, but I think there's a lot of merit to owning your home first. I think there's psychological benefit to just the comfort of owning your home and having a place that you enjoy and you live in and that you own. But there's also the secondary benefit, which is the tax benefits. For example, right, if you've owned your home and lived in it for 2 out of the last 5 years, capital gains, the first 250,000 in capital gains, if you're single, or 500,000 in capital gains are tax-free. It's huge. It's huge, meaning if you bought a $1 million home, and these numbers are kind of realistic in the Bay Area, right? You bought a $1 million home 6-7 years ago, you've lived in it the whole time, it's now worth 1.5. Again, what we were talking about in class 1 about being able to roll that money into more deals and kind of build that wealth. And going back to the first slide of like that penny compounding, that $500,000-$600,000 that you made when you sell that property, if you've lived in it, would be tax-free, versus in other assets or other things, you pay 25 to 40% capital gains tax on that. So just kind of thinking about the tax benefits there, because they're pretty substantial. I know some real estate investors, believe it or not, that like they just move every 2 years effectively. They go from like hot market, or they're just moving within the same area to just capitalize on the tax benefits there. Okay, so let's talk a little bit about market selection. So I'll leave this up for kind of 1 second here so that you can kind of digest and look at it. And this is kind of how I think about market selection. I think I said last week, well, at the end of the day today, hopefully you'll agree with me that there are a lot of good markets, and there are going to be some bad markets that you want to stay away from. But generally within the good market bucket, no one can tell you for sure this one's going to be better or worse. You kind of need to, look at your criteria and kind of decide how to move forward. But I think about it in these kind of 2 larger categories. So gateway markets on the left are considered safer, usually more like the coastal cities, right? People kind of flock to there. And what you'll notice there is the cap rate is lower in those markets, meaning the expected return is going to be lower because they're safer. Kind of like if kind of versus stocks versus bonds. Bonds are considered safer, so you get a lower return. Stocks are considered riskier, so you get a higher return. That's kind of how I think about it here a little bit. Growth markets are considered riskier because you're kind of banking a little bit more on that population growth to continue. Like for example, in a Reno or Salt Lake City versus, I guess pre-COVID, right? San Francisco is considered a trophy market, right? There's nothing that could really dethrone San Francisco or LA or New York or Boston, for example. And then the other thing too to kind of think about is like, I like to use another stock analogy, right? Like just say someone wanted to invest in tech, right? Tech's a very broad thing. Similar if someone's like, hey, I want to invest in real estate, right? In tech, someone can invest in Apple stock. versus Tesla. Apple, kind of more tried and true, I guess considered a little bit safer, right? Versus Tesla is a little bit more volatile. That's kind of the same way how I think about gateway versus growth. Same thing like if you want to invest in a media company, Disney, safer, Netflix, more volatile. And then one quick note about the cap rate. I mentioned that, lower, that's kind of the expected return. We won't really have time to get into the definition of cap rate and how that's all calculated. At a high level, it's kind of your net operating income divided by the purchase price. But a quicker way to think about it is if someone were to buy a property all cash, what would be the return on that building? That's what the cap rate effectively is. And the final point is just know that if you select a market to start with, and we'll get into this in the subsequent slides about building your team, it's not like you're set, right? I mean, ideally, you kind of start to build a critical mass in one of these locations before you move on. But know that like my journey was like we started off in Philly, we bought some properties in Austin, then we moved to Kansas City, for example, and Charlotte. Like it was just kind of we hopped because a lot of the skills are going to be transferable from city to city. So here's a little case study. We have Reno on the left side here. We have Albuquerque on the right side here. And kind of the question that I like to pose as you're kind of looking through these is what, if you had $1 to invest, right, in Reno versus Albuquerque, which one would you pick and why? And just know all of these stats that I'm showing you here are all publicly available. I think that's another thing that people are surprised by. Once you start to dig into the real estate data, you realize how much is available to our fingertips. This top part here is from Zillow. It's their ZRI. It's effectively a proxy for rent growth in these different pockets. So like, for example, in Albuquerque, you can see it's like decreasing in these areas, increasing a little bit in these areas. Job growth, pretty straightforward. This tracking from 2011 to about 2020. Just monthly data. So it looks like it's been pretty consistently growing in Reno versus Albuquerque. There's been months where it's declined, and kind of more volatile. And then rent growth, positive over 2 years in Reno, negative in Albuquerque. Population growth, we'll talk about that as kind of being one of the key stats to think about, but population growth is stronger in Reno than Albuquerque. So I always need to say this, but nothing against the people of Albuquerque, or if anyone has family from Albuquerque or anything. I haven't been there. But if I had to pick between one of these two, I think it's pretty clear, like Reno is a stronger market, right, to think about investing. And so that's what I kind of meant a second ago by saying on the good markets, I think there's going to be, a lot of potential good ones. On the bad one, like if there's a population that's growing below the US population and also rent growth is negative, that's one that I would just stay away from, because those are headwinds that you're facing that really, like, even if you buy a property at a great price today, it's probably trending in the wrong direction in the future. So let's talk a little bit about technology. Tech has changed the game for real estate investing. And I asked this question to the group, not as a rhetorical question. Is it necessary to see a rental property in person to buy it? I think a lot of people might think I'm crazy, because my wife actually and I have bought a couple properties in Austin that were sight unseen at the time. But let me tell you the story, because maybe it might help explain, why I don't think it's necessary every time. We had a contractor there that we trusted who toured the property manager who also looked at it and gave us a video tour, but also gave their thumbs up. And then our real estate agent who we trusted also toured the property as well. And presumably, as you're getting started in a market out of state, you're going to need to build that team, but those trusted allies of yours theoretically should actually know the market better than you. And all of them should have like a specialized field. Like, for example, a property manager should be able to tell you, is this property in line with other rentals in the area? A contractor should be able to tell you watch outs for like issues with the home. And same thing with the real estate agent. So maybe just some food for thought, right? Maybe it might not be necessary. And of course, I should back up by saying, if you have the opportunity to see a home, you should take that opportunity. But there's going to be some times where maybe you're submitting offers, right, 3 consecutive weeks in a row on different homes that hit the market and all check enough boxes and look good from the numbers that you're not able to fly to Austin or whatever 3 weeks in a row. And in those cases, you're going to need to kind of make that game time decision of like, do I need to see it? And maybe I should even back up, say on your first deal, right? On your first ones, you probably want to slow down a little bit and see it in person, but just food for thought for folks. And then this other piece too about just data, right? Like I think sometimes people might not be thinking about like all the things that are available to us, right? Like online without visiting a place in person, I can pull up the crime data and it's very robust. Like here in the city of Oakland, you can see street by street what has been flagged, what type of crime, and all of those types of things. Most cities have that type of access for folks if you really want to break it down. Population growth, that's all census data. Permit history and upcoming supply and permits pulled. Absorption rate is just a fancy word for what percentage of the units have been leased. So this kind of gives you a proxy for demand effectively in the market. Average income in the neighborhood, employment trends, are tech companies building new hubs, new data centers in those areas, and then a diversified employer base. Believe it or not, half of these things you can pull from just the Wikipedia of the city. Right, and like diversified employer base, you can get a feel for like, is it a mix of military? Is it a mix of hospitals? Is it universities, tech companies? The more diversified and more blue chip and well-known those businesses or companies are, the better, right? Because then if one employer moves, you still have whatever, 4 more that can support the local economy. And then Google Maps. Like I think this is like just so wild to think about, which is like the ability to actually scan a whole neighborhood through Google Maps without even physically being there. And also, I think I told the story last week, but I think sometimes looking at this data and also the Google Map view can make you less biased than if you were to fly in and drive around a couple times, right? You're actually using more objective sources of data. I still recall like one of my first trips to Philly. This was back in 2016 to look at rental properties. And I remember I took an overnight flight there. I flew, landed. I took an Uber to the little neighborhood called Manayunk. I remember I had a lot of this data already kind of typed up at my disposal. I also went on PadMapper, one of those websites to check on like rents nearby. And I just remember kind of thinking like, wow, like how many local landlords are using all this data at their disposal, and also what the future potentially holds. Because I felt like at that time it was like a very like only folks that like the technology was really going to accelerate how people start to think about real estate. You know, I remember just kind of walking around. It was like Manayunk, Philadelphia. I'm like, how many people from like California, NorCal have like come here to like search for rental properties? And I kind of felt like it was kind of on the new frontier, but I knew that like other folks I think would be, you know, following in this journey pretty quickly. And that kind of leads me to this last question for you to all think about too, which is, do you think you have an edge over the last generation's real estate investor? You all might know a family member, you know, parent, an aunt, an uncle who own rental properties. They might have some horror stories for you for XYZ reasons, but really think about, do you think you could do it better than them, you know, objectively, you know, just in terms of your ability, your vendor list, even like, for example, Yelp, using Yelp, right, is an advantage that people nowadays, younger folks nowadays can do, right? And like Yelp messaging, you can reach out to 10 vendors at once to get a quote. It's pretty spectacular stuff that wasn't available to folks, you know, 3-4 years ago, even. Okay, so let's talk next a little bit about picking a market to invest in. In this class, we're going to be talking mostly about out-of-state investing, primarily because I live in California and it's just really hard to make the numbers work. So look, I know folks on this call, they might be looking in their local market. And I think there is merit to doing that, right? It's safer, and I put it in parentheses, quotations there, because of what we just kind of went through, which is like, it might not necessarily be safer. It might feel safer, but it might not be objectively safer if you really look at kind of the numbers behind picking a market. But I will say that like the benefit of local market is you'll have local knowledge and contacts. And that can be really, really helpful when you get started. If you do know of a contractor or a handyman, that would give you a leg up, someone that you trust nearby. But on the other side, to really think about kind of the negatives of the local market. one, starting out of state, it forces you to think like an owner and put systems and processes in place. Like I like to say, I cannot change any of the toilets in Philadelphia. If there's a leaky toilet, I cannot attend to that. That's actually a benefit, right? As you think about scaling up your portfolio and really making this into a more like passive income and finding a way to build a portfolio enough where it can kind of give you some of those freedoms that we talked about in the last class. And also, I think you hear this a lot from older landlords who've invested locally. They say, oh yeah, that leaky toilet, hey, that issue came up, and eventually it just becomes a job, right? And they get really worn out and tired from the process. So thinking 2 steps ahead, like eventually to scale, you're likely also going to need to go out of your locale as well. When picking a market, these are the key metrics that I would focus on. We talked about them a little bit on the last slide, but the number one for me is population growth. Population growth, in my opinion, dictates a lot of things. When people move into an area, businesses, restaurants, all of that good stuff, even transportation, and rents typically increase as well. It's kind of like the lead measure to see where a market is trending. And then also, I'm very closely tracking job growth, diverse employer base, ideally 5 or more major employers to that area. I think I kind of gave a silly anecdote last week of, there's a property in Tennessee that someone had sent me. Numbers look great, but it was something like 20% of the local employees were working at a Tyson chicken farm. And it's like, that's just too risky, right? To have everything consolidated with one employer. Rent versus purchase price. There used to be a thing that a lot of people talked about, which is the 1% rule. That it's harder nowadays to find deals that match that criteria, but that's a nice little quick way to figure out if a deal will likely cash flow. An example of that is, you buy a place for $100,000, rent each month is $1,000. So $1,000 is 1% of 100,000. That very likely will cash flow. And assuming it's in a decent location and a decent neighborhood, it should be a pretty good rental property. Of course, you want to dig into more of the numbers. And next week, we'll talk about what that underwriting, kind of analyzing a deal looks like. And then lastly, rent growth. But rent growth, I think, usually kind of falls in line with population growth as well. And then the last point here is just to really don't get bogged down too hard on the picking a market step. It is a critical step to go through and think about, but I think a lot of people kind of just hit a wall here where they, analysis paralysis. There's a lot of good markets to pick from. There are some bad ones. So the bad ones you want to stay away from, but there's going to be a lot of good ones. And just starting to make forward progress once you've decided which of those good markets you want to consider. Here's an example of like a chart that you could put together, right? And this is kind of what I meant by, there are a lot of good markets out there. I'm sure folks on this call might know people that have invested in Nashville or Charlotte or Tampa. There's no like perfect answer to this. It's not super black and white. But once you put together a table like this, you can start to see which markets might be more favorable. You start to think about which ones you would kind of want to put more chips in and kind of start to make investments in. And then in the email this week, I'll share with you all a link, but that's the other thing too, is there's just a wealth of kind of like free information out there, like CBRE, Marcus and Millichap. There's a lot of big commercial real estate firms out there that produce quarterly annual reports on the real estate market. And I think people are generally surprised like how much is out there. So I'll share a link with a few reports that you can all start to dig into as you're considering different markets. And then the last piece, I guess this is kind of related to real estate cycles, but I just wanted to share as well, because like I think I mentioned in the first class, my goal is to really give kind of a balanced viewpoint on the real estate market and where we're heading. I'm generally very bullish. I'm a long-term investor. I think there's a lot of opportunities, but I also want people to kind of have eyes wide open on real estate operates typically in cycles. Right. And I think the best way to kind of look at this chart, this is a little bit dated, by the way, this is from 2018. So the bullets and the cities and where they land on this are a little bit dated, but the gist of this message still holds true, which is like looking at this, right? Stabilization. This was like after 07, 09. Kind of think about like the market has kind of stabilized, kind of like settled down. And then over the last 10 years or so, we've really seen, pretty significant like expansion of the market, right? The real estate market has been effectively really hot. Rents are going up, prices are going up. And I think, more than likely we're closer to at this point of kind of maturation, where things have kind of stabilized, slowed down. Who knows where we're headed, right? I think we're probably entering a time of potential contraction, just so that people are kind of aware. And the way the cycle typically works is during this time, right, rents are increasing, everything's going up, and people are making a lot of money in real estate. So generally what happens is there's more supply that's being built. Developers are trying to build more homes, fix and flippers are trying to flip homes and get them ready for sale. And at some point, that market imbalance flips from there being too few supply and more demand. So in this part, demand is outpacing supply. And at some point that flips. Demand tapers off, and then there's too much supply. It's effectively a story of human greed, right? If you boil it down. And once that oversupply starts to happen, or demand tapers off because of interest rates, for example, then you enter a situation where it's contraction. And prices typically will come down in that period, or the market will just slow down during that period. So I just wanted to, share that just so folks understand, hey, there is a cycle. Funny enough, when I started this class earlier this year in March, it wasn't, it wasn't clear where kind of the market was headed. But I think now with the slowdown, I think more folks are, feeling, hey, we're probably entering, we're definitely closer to the top, right? And there's, some slowdown that's already happened. Okay, so let's talk about building your team. This is a very simplified chart, but I think it gets the message across. You're the investor, you're in the middle. You're kind of in the driver's seat, so to speak. And there's really only 4 people on your team that you need to run a rental property. In fact, contractor at the bottom right is kind of optional. It really depends if you're doing a lot of rehab. Some properties you buy are ready to rent out already, so you don't really need the contractor. 3 key folks, and we'll talk about them on the next slide. So the property manager, just in my opinion, is the #1 most important piece of the puzzle. They're taking the phone calls from the tenants. They're also helping you lease usually. They're critical. The realtor is helping you find the property effectively. And then the lender is providing the loan. That's kind of like the trio that you need, and the potential contractor if you're going to be doing some rehab. So building your team, I think I want to caveat this by saying this is where the rubber meets the road if you want to get into real estate investing and directly own property, which is real estate is a hustle game. It is a game that requires you to pick up the phone, talk to people. That's kind of like where the money's made effectively, right? And what I mean by that is like property management selection, you're going to need to interview a few property managers, right? I typically have kind of a list of questions that I go through and effectively interview them to see who is kind of a good fit to be your property manager. And as I mentioned, I think property manager is kind of your most important piece of the puzzle. Typically for a single family home, they charge like 7 to 10% off the top for management. And for a multifamily building, call it, I don't know, 10, 20 units plus, that might scale down to 4 to 5% of rents going to the property manager, but well worth it. Like a good property manager is worth their weight in gold. I'll give you a quick example. Okay, a bad property manager, okay, a phone call comes in and the tenant says, hey, my toilet is clogged. They call at 7 p.m. So it's a late night phone call charge. And they say, okay, I'll send out an emergency plumber. And then they fix the toilet, you get billed for $300. Okay, that's I would say medium to bad property manager. A good property manager, right, takes that call, and the first thing that they ask is, hey, do you have a plunger? Can we try to sort through this together quickly for 5 minutes and see if we can unclog it? Maybe it's something like really, really simple. And that in itself saves you $300 as the homeowner. So I think there's that level of kind of rigor of like the property manager kind of thinking through a little bit more critically that makes them worth their weight in gold. And then the next piece, a local lender, right? So when we talk about getting a loan, usually it's going to be from a local lender. I don't know too many seasoned real estate investors who are using like Bank of America for all of their loans, for example. And especially as you get into bigger properties, commercial properties, multifamily that are multiple units, very, very rarely are people going through B of A or Wells Fargo or any of the big banks for their loans. There's just too much red tape. The underwriting process is really difficult. And believe it or not, you can start to build inroads and relationships with these local lenders. Like my lender in Madison, Wisconsin, it's just a couple guys that are kind of part of the loan committee. So if you have a proven track record, they know that you're serious and know what you're talking about. The loan approval process can be a lot streamlined. And so the tip there is to think about reaching out to credit unions and local banks. Pretty much in every market that I own property, there's a local bank that we work with. And this is what I meant by the rubber kind of meeting the road, which is how do you get that list of good banks to talk to? Well, you make a list of 30, 40 banks in the market, and you start to call, you start to email all the loan officers asking them, what are your loan terms? That's, I think, a big misconception too with folks is not all banks offer the same loan terms. A loan is not a commodity. The cash at the end of the day is a commodity, but some banks use their loan programs to garner new business, and some are just better at loan terms, right? And generating business from their loan terms. Picking a real estate agent, I would say maybe a first step, you can always ask me to see if I have any recs. Our team has pretty good connections in a lot of cities across the country. And then, so I'm going to skip here and say, you want to call 5 agents. Same thing with kind of having to pick up the phone. You probably want to interview a few people, talk to them, make sure they're on the same page with you and understand that you're looking as a real estate investor, not as a primary home owner, because the rental property investor is going to be thinking things about more numbers and cash flow based. And also you want to make sure that the realtor understands how to calculate those as well. And then this point about being upfront with what you have to invest, that's something that only in the last couple of years would I say I've really started to understand, which is I used to be really afraid, right? Like calling different folks. I would share only a little bit of information. I'd say, hey, I'm looking to buy an investment property in your market, and kind of wait for them to give me information. And I had a really insightful conversation with a seasoned investor who said, you need to share as much, or not as much, but you need to share more information with them up front. So think about someone calling you, right? There's 2 different people. One that says, hey, realtor, I'm looking to buy an investment property. Versus the second person that calls is like, hey, realtor, I'm looking to buy an investment property that's $250,000. It needs to cash flow $100 a month, and I'm pre-approved with this XXX local bank. Between those 2 folks, you can kind of imagine who the realtor is going to take a lot more seriously, because that second person knows what they want, right? And they're sharing that information to the realtor. And then last point here about contractor, it's generally pretty hard to find good contractors nowadays. A lot of them are super busy because people are doing rehab, or a lot of people are also renovating their home because of COVID, and they kind of need more space or want to update different parts of the home. So your property manager might be able to help with this. And also being understanding with what a good contractor is. A contractor is someone that's usually pretty good with their hands, can do the work well, but they might not be the best communicator. They might not be the best with responding to emails timely, right? A good lesson that I learned early on, someone said, if a contractor was good with all those things, running the business, the accounting and all that, to be frank, they probably wouldn't be a contractor. They'd be a real estate developer, right? So just kind of, just kind of being mindful of that. And then also price, quality, and time, and finishing the work on time. Usually you can only have 2 of those. If your contractor is doing 2 out of those 3, that's considered a good contractor. And then the last thing is on the contractor piece. One lesson that I learned the hard way, you want to think about paying them what's called a third. You pay them upfront a third for materials so that they can buy the supplies. You pay them a third at the halfway point so that they still have half the project to finish, but they've only been paid 2/3. And then you pay them 1/3 at completion once the project is 100% complete. You hear horror stories, you hear bad things of when people effectively pay the contractor too early, then they stop showing up to the job. Why would they keep working at that point effectively? Okay, so anyone here read or listen to the audiobook, the Will Smith Autobiography that came out recently. This was, well, I guess this was all before all the Oscars, Chris Rock slap and all that stuff. It feels like you can't really talk about Will Smith nowadays because of what happened. But hear me out. So the Autobiography had a really inspiring story in my opinion. So it talks about how Will and Will's brother were building a brick wall, and they lived in Philadelphia. So you can imagine the summers were sweltering hot, the winters were freezing cold, and they were building this wall, and they just weren't really making much progress. And then Will goes to his dad, out of frustration and says, like, Dad, this wall will never, ever be built. And then his dad, turns to him and says, that's because you're focusing on the wall. Focus on the brick. And Will Smith actually still, like, if you randomly watch interviews of him on YouTube or, talks about it in the book, he still thinks about that story all the time. And I think it's really insightful for real estate, which is like, don't focus on the destination, right? Keep the destination in mind. But if you're thinking, how am I going to get to $20,000 a month cash flow? How am I going to get to 100 units owned? That's not the best way to pursue the journey, right? Just do one step at a time, right? And then you'll get there. You'll look back and you'll realize how much progress you made. You'll complete the wall before you know it. So that was my attempt to be motivational to you all. So here's your brick for the week, if you choose to accept the mission. Okay, so spend 5 to 10 minutes this week creating positive momentum. Just pick one market to analyze. That's it. Any market that you can think of. If you live in Oakland, like I do, just think of Oakland. Just any city that you've had any interest in real estate, and just pull these stats: average rent, average purchase price, population growth, top 5 employers. Just by doing that exercise for 5 or 10 minutes, you'll probably have a decent sense if it's a good rental market or not, or whether you want to keep double clicking and going further. And then if you decided not to buy a rental property, I'll send over a couple decks. They're called offering memorandums. So just so you could see, like, when these private real estate deals happen, how do people evaluate them? How do people send them out? And just look through it and just email me one question. That's it. Just one brick for the week. And then also, if you haven't yet, send me your mailing address. I'm planning to send out books to everyone later this weekend. And that's for those 2 books that I referenced in the first class. And then just to wrap up, a couple quick slides here. So let's see. Oh, the image is not showing. Oh, darn. Okay, well, anyways, there's an image of the Wall Street Journal article. It just came out in the last 2 weeks, actually. And the title of it was talking about laptop landlords and the emergence of people effectively doing analysis on rental properties through online. And here, let's just look it up actually here real quick so you can see it. Everyone's a laptop landlord, snapping up out-of-state properties. So I just thought that was kind of funny, that it's like when the Wall Street Journal is talking about what you're doing. Maybe that's a good sign. I don't know, but it seems like it's definitely becoming a little bit more popular for folks. And I thought the term laptop landlord gave me a good chuckle. And I'll link this too, because I think it's just kind of insightful. They had said something like, in some markets, 2% of properties that were purchased, I think in the last few months, were from these laptop landlords. A sizable amount, if you really think about it. And then, yeah, last slide. Follow me on Instagram if you have any, just so we can kind of stay in touch, and I'll also have future class updates on Instagram. This is the link to get your book order in. And then thank you all who scheduled time to chat. It was really cool to connect with Jason and Quentin and Alan this past week. And I had someone in the last, from class 2, so this is all part of group 3, you guys are part of group 3, someone part of group 2 that I hosted in April, they just texted me and said they closed on an Airbnb in the last couple weeks. So that was really cool to see. All right, any questions from the group? I will go through the chat right now. Oh, yes. Sorry, Giovanni asked about putting the slides in presentation mode. I'll work on that. Yeah, sorry if it wasn't clear today. Tiff, Tiff, my sister, is on the call. She asked, what does LP stand for? That is a limited partner. Yeah, limited partner meaning you effectively invest with that group, and you take on effectively limited liability by investing with them, and it's almost more passive. It's not like you're owning the property directly. You're owning shares. It's almost like buying a stock. Think about it that way. You own shares of the entity that owns the real estate, but you don't own it directly.
Okay, thanks.
Stacy asked, is there a website to source that you could recommend to get this data for major US cities? Jason sent the Fred link. I think that's a good one to start if you're thinking about kind of more high level numbers. Wikipedia is a good one. Population information is off the census as well. And some people might argue this is not the best way to do research, but if you just start off with a Google search on that city, you'll find usually pretty good sources, either local news channels that are citing different things. So it's not always the same path always. I guess usually I start off with Google though, and then you can dive into better resources. And I'll also share a few good research reports with folks.
Okay, thank you.
Interview list for common questions asked. Yeah, I'll put something together and I'll share with folks. A couple things that come to mind, Jenny. One is, well, just understanding kind of their philosophy on property management and how big their team is. One barometer that a real estate investor gave me that was pretty good is you want about 100 units per property manager on the team. And then I would say it depends on the city and how many units are available. But like in Philly, my property manager, I think he's managing about 500 units, 700 units. That to me is kind of like a good scale. He's not too busy, and he has 5 or 7 property managers on the team. They have enough scale to understand kind of rents in the market, but they're not just like a big monster corporation as well. And the, timely responses and all that stuff. There's a question, is there a resource available for a simplified list of rental laws in each state? That would be relevant. Tenancy, tax laws, benefits. That's a good question. I don't know if there's a centralized resource that I found for that, but you bring up a really, really good point. I mean, I would, in any market that you're considering, that is one component to think about, which is landlord friendliness. I think I mentioned in the first class, but I know some folks who don't even look in California, for example, for their rental properties because of how tenant friendly the state is. And I believe I was just doing some research on it last week. I think there's only 4 states that have rent control to begin with. And then generally the red states are considered usually more landlord friendly as well. Believe it or not, there are a lot of states out there. This was wacky for me to even learn about. There are some states out there where landlords do not have to give notice before entering the property, which I didn't know that was a thing, but that is true in some states. Oh, and then Wendy also mentioned nolo.com for specific legal questions. That's a great call out. Bentley asks, are there any roles ever in-house or on payroll or all services that you're contracting? Good question. At this point, I'm contracting everything. I'm kind of at a funky point in my real estate career, I'll be honest. We own about 70 units. It's not enough to hire a manager to manage all of the property managers, if that makes sense. We'd effectively erode all of our cash flow. But so that's kind of we're kind of like at the teenager phase. So we're kind of needing to decide, like, do we kind of grow the portfolio or kind of keep it steady as is? Because that's, there, as I mentioned in the first class, right, there's just more things, right, that kind of pile up eventually over time as you're adding more units. So right now we're at the point where we're outsourcing everything to property managers and their vendors. But you're right, like if we had enough scale at some point, call it 100 units plus in one market, we'd probably really consider bringing stuff in-house. You might have an on-site property manager, for example. For our properties in Madison, Wisconsin, like snow removal, landscaping, those are things maybe have like a maintenance person on staff that handles those things. And what's nice about that is, well, the pros and cons is you can usually reduce expenses by managing it in-house, but the cons are now you have payroll that you're managing and an employee that you have to manage. Financing question: how do you think about getting started as a lender? What do they lend against in terms of assessing your credit worthiness if you want to do this as a business LLC, personal recourse versus not? Okay, great question. So,
and I meant to say with a lender, not as a lender, just to clarify.
Oh,
just
yeah. Yeah. Great question, Bentley. So that's the other fascinating thing about real estate, which is as you get into these bigger projects, and everyone's at a different point, right? It depends kind of how much investable capital that you have, kind of going back to this slide here. But believe it or not, folks in this tier 3, most of the loans that they take out are what's called non-recourse, meaning if the property goes south, I mean, there's going to be a ding on your credit, of course, and it doesn't look good, but there's no recourse against your personal assets. You pretty much just hand back the keys. So in many ways, real estate investors who are doing big time deals, like 100 unit plus, right, big commercial deals, are actually taking on less risk because there's no recourse to their personal balance sheet. It's really fascinating I think for people to learn about that. I mean, there are things called bad boy carve outs, meaning like you can't defraud investors or the bank, and then there could be recourse. But if you're not doing those things and you're playing by the rules, there's no recourse against your personal assets. But in those cases, when you're doing those bigger projects, almost always are you buying with an LLC, because that's what gives you that liability protection. And then also related to that, on those bigger projects, there is sometimes some check against your personal assets, but it's not like a DTI, debt to income analysis like a bank is doing when you buy your primary residence to live in. The building itself, the 100 unit apartment building, is a business in itself and should sustain the mortgage payments and the debt load and all of that. So really the primary analysis is on the building. Secondarily, there might be some, what they call like a sponsor might need to sign off. They kind of need someone like that has a net worth equal to the loan amount, just to kind of balance things out so that it's, so yeah, I think it's kind of like different routes. It's like for the smaller investments, you're going to need to do a traditional loan and kind of there's going to be recourse there. But believe it or not, on these bigger ones, there's non-recourse typically. Emily asked about, how do you know the property manager isn't faking issues and pocketing the money? I don't know how to answer that in an absolute way, but I would say, a good property manager, right? Reputation matters, right? I think that's a similar question that I think, like, as a real estate agent gets asked sometimes. They're like, oh, are you lying about the number of offers or something like that? And like the reputation in this industry is so important. So if someone found out, for example, a property manager is making up fake issues and they wrote that negative review, is not worth trying to fake any of those issues. And also to kind of back that up, usually there's ways to have photos and ask them, and also knowing just what's reasonable cost, right? If your toilet is brand new and they're saying it needs to be replaced, that probably is a red flag. But if it's a 20-year-old toilet, might be reasonable that it needs to be replaced. Oh, and also I'm thinking getting multiple bids, right? If 2 or 3 vendors are all saying the same thing, then unlikely that the property manager is lying. Quentin asked, you mentioned calling many banks and asking for their loan terms. In my experience, they won't give you that data unless you let them do a hard pull on your credit. How many is too many hard credit pulls for shopping for loans? Is there a number, or is there a better way to do this? Okay. I would say it depends. Like if you're getting pre-approved for like a primary residence, they'll usually need to do the underwriting, and they won't give you those initial terms. But even like, for example, like you can go on Wells Fargo right now, and I think you guys can see my website or my browser here. Sorry, there should be interest rates. Most banks have something available that you can see, and it might not be exact, right? Because once you go through the underwriting, it'll be a little bit different, but ballpark, right? You can see these things. Here's another credit union that I use. Oh, it already popped up. We can do Stanford Federal Credit Union, mortgage rates. These things are usually somewhat publicly available to folks. Purchase rates, 30-year, 15-year, jumbo, refinance, investment purchase rates. So typically investment loans are going to be higher because it's riskier to the bank. But these things are usually pretty generally available. And then if you're talking about more like commercial loans, then those usually you just email the loan officer. But I've never had a situation where the loan officer didn't share that upfront. I usually just ask, hey, my name is Cliff. I'm interested in buying this property. Purchase price is X amount. What are your loan terms? Keep it pretty simple, and they'll tell you. And once you get into the commercial loan space, you realize that there's so many different loan products. There's some that are 3-year balloon, 7-year balloon, 10-year balloon, 20-year amortization versus 25, different interest rates, because the commercial loans are more like in-house products. So they don't, for example, like Wells Fargo here, these conforming loan and jumbo loan numbers are going to be really close across the big banks. If you went on B of A's website, I think these would be pretty close, any of the big banks. But the commercial loans that are more of the local banks, they're going to vary quite a bit.
Cool, thank you.
Yeah, good question, Quinn. And then Kobe asked, thoughts on investing in public REITs for those who don't want to be hands-on. Isn't that similar to holding a dividend stock and still subject to public market fluctuation? Yeah, that's generally true. But I think investing in a REIT, if you don't have any real estate exposure, could be a really worthwhile step, right? Because kind of this concept of like alpha, right? Or diversification, right? If you have like 2 stocks or 2 investments that each would give you 10% expected return, right? Some people would say it's actually potentially smarter to split your money between those 2 investments, because you're now still expected to get 10% in total, but now you've kind of spread out your chips, you've diversified, right? And they're not super correlated, right? If investment A tanks, you still have investment B kind of holding up the ship. So I just generally, I'm just more of a proponent of like folks diversifying. And I don't think it's necessarily the same as holding a dividend stock, because a dividend stock, right, that stock could be a tech company. Like you're not getting the same diversification unless it's a real estate company specifically.
Got it. Yeah, I also thought like when interest rate kind of environment changed, it kind of impact the dividend stock a certain way. And then I tried looking at the price pattern of some REITs that I pulled up, and they seem to have a similar trajectory, maybe at the time, and I just have a small sample. But I get your point on just broader kind of alpha diversification.
Yeah, but yeah, you bring up a good point, Kobe. And good to hear from you, man. It's been You still playing basketball?
Definitely, yeah. And I moved to New York now, so it's good to catch up.
Okay, cool, man. Yeah, I think that's like the point of this class, right? Is like, I think my general message to folks is like, folks should generally consider real estate investing. Whether you want to be a direct investor like me and own property out of state, that's one thing, or you can buy a REIT, as you mentioned. And there's so many different categories. Like you can invest in like industrial warehouses, right? If you're bullish on that, but at least that's good exposure to like diversify your assets, and it's still real estate focused. Nice thing about a REIT typically is it's a fund effectively, so they're buying multiple real estate assets. So if one is in a bad location or one doesn't perform well, then you still have others that are kind of holding the portfolio up. So yeah, good question.
And since I'm like, I think the last question I see, I have one more kind of philosophical point. I live in New York now, and I'm starting to see the result of like climate change. You see more flash floods and basement getting flooded. It's expensive to get repaired. You hear in New Jersey, there's tornadoes hitting houses over there. So kind of, how do you think about that in terms of like, now historically has worked well for a landlord to build wealth, but now the risk kind of shifting more to the landlord side. For someone who has more exposure like you, how are you thinking about that trend?
Yeah, it's a great question. It's something that my business partner and I have kind of started to talk about a lot more lately. It's not really in vogue in the real estate investor community. I don't think too many people are like, for example, like I think Miami and other places. It's not like in the imminent future, even though I think people think global warming will affect those areas eventually. So something to keep on your radar, and I think it needs to match with your investing timeline, right? If you're thinking, hey, these properties in 5 years I'm going to likely sell and 1031 exchange into something bigger, then probably not that big of a concern. But if you're thinking this is buy and hold, stuff that you might pass off to your heirs, to your family, then probably you want to be considering that, right? And weigh that factor even more. Yeah. But I think it's just gonna, I don't know when it's going to become super in vogue and everyone's starting to talk about it. I think it's going to take some time, in my opinion. Yeah.
Thanks.
Yeah. But and there's that other question too that someone brought up about landlord friendliness and global warming. I think those two are the things that actually I will update my slide because of those two questions, because those are the two things I think people should at least keep in the back of their mind when picking a market. So great questions. And then Valley said, yeah, Ken Griffin bought $100 million oceanfront property. He's not concerned about flooding. Yeah. But I also think that 100 million is a drop in the bucket of his money probably too. So cool. Any other questions? This was a really kind of robust Q&A. So thanks for all the questions that people asked. All right. Don't forget to sign up for the books if you want them. I really want to send those out to folks. I think I might have been too harsh with my words last time, because I think for the first two classes, almost everyone signed up for the books. And then this time, I think only like a third or half the people. So maybe I was too harsh with saying, if you're not going to, don't order it if you're not going to read them. If you think you're going to even peruse it a little bit, put your name down. I want to send those books to you. And that's it. Yeah, I'll stick around too for a few minutes. I realized last time I just ended the call, but if folks wanted to ask a more one-on-one setting question, I'll stick around for a few minutes. But thanks so much, y'all, and have a good rest of your night. Good to see y'all.
Thank you.
Take care.
Thank you, Cliff. Bye.
Bye.